Banks typically gives two type of financing for business entities. One is working capital, the other one is term loan. Working capital is given for supporting their day to day operations of the business because funds are getting logged in inventory and receivables. And how they do that assessment, they look at the balance sheet position in the past as well as in the estimates and projections. But that method has a limitation because it cannot be applied for all the businesses. For example, if you take tea industry, you cannot come to a conclusion about their working capital requirement just by looking at the balance sheet date, because they are going to have something known as peak season and non peak season. So when they have two types of season, their working capital requirement will also be different. In peak season they'll have maximum working capital requirement, and in non peak season their requirement is going to be very minimal. So in those cases, if you are going to come to a conclusion on their working capital based on the balance sheet position, then it will be lopsided. It may not really help the unit. So in those cases, how to go about? You have to arrive at two working capital limits, one for the peak season, the other one for non peak season. How to learn all this? Check our comprehensive course, Credit and Financial Analysis Mastery. Just come and demo and get its demo version.